Let's find out how we should evaluate our tax-saving funds and why they're underperforming the broader market. And to do that, of course, we have to bring in Dhirendra Kumar, the CEO of Value Research. Dhirendra, good afternoon to you. Thank you for joining us on this Monday afternoon. If we take a look at the performance of our tax-saving funds, it hasn't been very strong. The category average of tax savers is currently underperforming the Nifty and the Sensex. The Nifty, for example, has returned about 7% over the last year, whereas tax-saving funds category average has returned about 3%. Is there a reason for this underperformance, and should we now start losing faith in the way our tax-saving funds are being managed?
No, the reason is quite understandable that, these tax-saving funds, they are much more into mid-cap and small caps, and, the weather has been very bad for that segment of the stocks. And when we compare it with Sensex and Nifty, which is largely large cap, so that is the primary reason, and that is exactly the reason why you should not lose faith, because, of course, 3-year as well as 5-year return from most tax-saving fund is extremely disappointing, and most investors also have a very clear reference because they have the choice of putting their money into a tax-saving bank deposit where they would have earned more, or they could have invested in National Savings Certificate or PPS, and that will also entail the tax saving. Plus, they would have got the fixed income, which will be higher than what they are earning, if they realize it. But that is the risk of equity anyway. And I don't think people should be considering the tax saving fund for a 3-year time frame. If you don't have time on your side, you should not consider them. So the reason why tax saving funds have underperformed is the reason that in a good market they will handsomely beat the benchmark as well. But this is not the time when we can say that.
But Dhirendra, then tell us this. If you're telling us that beating the fixed income return right now is a good thing, how should we assess our tax-saving mutual fund? Should we be comparing it to the Nifty and the Sensex, to its own category average, or should we be just aiming to beat a fixed income or a fixed deposit return?
Yes, I would say that over a very long period of time, if you are able to beat the benchmark in 5, 7 years, 10 years, I think, you will understandably, without much of a problem, able to beat the fixed income returns. And if you are not able to beat the fixed income return, I think the case for beating the benchmark over a sustained period also will disappear. So I would say that in the interim, if you are invested in equity funds, I think the least you should expect is that it is beating its benchmark. And beating its benchmark consistently should be, should be my yardstick. And, many funds are able to beat the benchmark. When we are looking at the average return, it is an average of about 45 funds. And I think, there are 15, 18 funds which are able to beat their benchmark reasonably well.
Well, Dhirendra, that obviously leads me to my next question. Now, we're already in the month of September, which means we only have a few months to go before our deadlines come in to submit our tax papers. So give us a list of tax saver funds that you would recommend for this year that form that list that you were just talking about.
Among the funds which, with reasonable history, I would say ICICI Prudential Tax Plan, the Canara Robeco Tax Saver, and Franklin Tax Shield. I think these are funds with credible history. A relatively new fund which has been very impressive in recent years, and little over 3-year-old, is the Axis Eager Tax Saving Fund from Axis Mutual Fund, which has been very impressive of late.
Alright, so I'm going to go over that list one more time. This is the list that Dhirendra recommends for all of us if we're saving tax for this year: the Axis Long Term, the ICICI Prudential Tax Saver, and the Franklin Tax Shield. Dhirendra, we have a question also from one of our viewers today. Kisan has written in from Hyderabad. He's been investing 1,000 rupees a month in the Canara Robeco Equity Tax Saver Fund for the last 1 year. Now, this is a fund that you've personally recommended on this channel over several years. He wants to know what the future prospects of this fund are. He also wants to increase his allocation to 2,000 rupees a month, and he wants to know if that extra 1,000 rupees should be in the same fund, or is there another fund you would recommend? He has a 10-year horizon, which is always heartening to hear. What would you recommend he does?
I would say that, this is a good fund, and if he wants to keep it uncomplicated, it might be worthwhile. If he's just keen on, adding one more fund, I think, the Axis long-term equity will be a reasonable addition to his portfolio.
All right, Dhirendra, thank you so much for joining us on this show this afternoon and answering all of our questions. If you have a question for Dhirendra Kumar, write to us. Email ID is on your screen right now.